Okay, we are going to go through the topic of term insurance riders and objections we hear around term riders in terms of designing a policy for maximum cash value. 1090 split, not 1090 split. How do I just get the most money at the end of the day? That's often what we hear. How do I maximize my cash value first and foremost, and then begin to use it for opportunity? So here we go. When it comes to term insurance riders, I have a couple types. So specifically with a whole life insurance product, I can often add a level term insurance rider, like a 10-year term rider, for instance, which is level for 10 years. After 10 years, it falls off. I can cut it off prior to the 10-year mark, but whatever that term rider cost is, it is guaranteed to be level for that 10-year period. That is one type. The second type, which I am a huge fan of, is the 1-year term rider, and this is a blended PUA rider. This is a combination of money going towards a 1-year annual renewable term insurance rider, and the rest of my money goes toward the PUA rider, which accelerates my cash value and also purchases me more whole life insurance death benefit. So we're going to go through each of these in detail, but to kind of sum it up, the level term rider is level for 10 years. Or whatever the term is. It could be a 20-year term rider, 7-year, doesn't matter. If my premium is $1,500 per year, that will be $1,500 for 10 years. Whereas the 1-year term rider, that price will jump up every single year. I should say the price for every $1,000 of term insurance attached to the policy will increase. However, you're going to see this, and we've got other content on it as well, that 1-year term rider will often decrease on a whole life insurance policy as my whole life death benefit increases. The point to mentioning that is while the internal cost can increase, the net cost to me, the policyholder, can decrease. We're going to show you that too in all scenarios. What's always important to look at are the current expenses, what the company is presently charging for a 1-year term rider and a level term rider, and then also the guaranteed expenses. Now the guaranteed expenses, what that means is every insurance company reserves the right, if they want to or if they need to raise the cost of riders, fees, term riders in this case, on life insurance policies. With a level term rider, if it's guaranteed to be a level premium, we don't have to worry about it. Some have a level term rider, but at the same time, they do reserve the right to increase it. Always good to look at the contract language. But with a 1-year term rider, that will increase. So what's good to look at is on that blended PUA or 1-year term rider, how much will it increase based on the current expenses? And then how much will it increase based on the guaranteed expenses? Similar to a level term rider, you can also chop it off or reduce it anytime after the 7th policy year. And we can look at that in more detail as well. All right, so we're going to take a look at a couple things here in this video as we progress through. MEC implications, this is very, very big. With a level term insurance rider, if I have an intention on funding a policy for a long period of time, and I have a level term rider attached, a 10-year term rider, for example, when that term rider falls off, I am going to have what is called a material change, which means I will have to reduce my payments or stop them altogether. Usually a strategy we hear and see is if we have a level term rider, you can max fund the policy for 10 years, but once that term rider falls off, we drop our payment down just to the base premium, meaning we're no longer adding money into PUAs. We often hear it, hey, at that point, you should take out a new policy. Okay, so that's one option, but it's very important to be aware of if I have a level term rider, when that falls off, I will have a material change, and that specifically means my MEC limit will adjust and I will be forced to pay in a reduced amount. That'll happen with a term rider 10 out of 10 times. When it drops, when the death benefit drops, I've got a material change, i.e. a MEC limit reduction. So that's where we've got that strategy. We here reduce the funding or open a new policy, which means we have to go through those expenses again. Important to keep that in mind. With a 1-year term insurance rider, that does not cause a material change. Now, what's important to mention here, it doesn't cause a material change or a MEC limit reduction because we can keep it on as long as we want. The thing that's important to be aware of there though, when we keep that term rider on, the 1-year term insurance rider, is making sure the cost does not grow too excessive. Easy to prevent because again, your whole life goes up, your term comes down, which results in your costs going down. But also, the 1-year term rider can be removed. It can also be partially reduced. So we can always chop it down to lessen our costs. Here's my favorite part about it. Provides flexibility. So often we'll talk about policy design and having the ability to add the dollar amount that I want. For example, if I want the ability to throw in, let's call it $150,000 per year into a policy, I can design a policy with a minimum premium of $15,000, have that 1-year term rider attached. That might be $1,500, whatever it comes out to. And then at my discretion, I can throw, I'm just going to round this off, another $135,000 into PUAs per year. Now, I can do that without any medical underwriting if I have that 1-year term insurance rider attached. And a big reason why is as I pump money into that rider, my whole life benefit comes up, but my term comes down, keeping me level at the exact same death benefit. We're going to see some examples. I'd also refer you to our OYT full transparency video if you'd really like to dig into the 1-year term rider. So to look at some numbers, let's have some fun. First, we're going to look at a comparison of a policy with the same company on a 45-year-old male paying in $100,000 per year. We have a 1-year term rider, 1090 split, and then we have a 1090 split as well with a level term rider. You can use either one. So what you'll notice here, 10K base premium, level term rider starts out higher, $2 million, net death benefit about $2.8 million. With the 1-year term insurance rider, it's about $2.4 million. This guy has an approximate $100,000 MEC limit, a little bit higher. This guy is closer to $118,000 MEC limit. If we're going to suddenly drop a term rider, it is very, very important that we overinflate that MEC limit or stress test it up front. We do this with level term riders to make sure we do not trigger a MEC, not based off just a current illustration, but also based off the midpoint values, guarantees. Important to look at everything here. But here's what we notice. As time passes, what do we got going on? Level term cost, break-even point between years 5 and 6 with a level term rider. We maxed it out. Minimum premium, maximum PUA payment. Total costs over here, pretty straightforward. I mean, it's just $4,140 times 10. That's where you came up with the $41,400 toward term insurance riders, the level term rider. And then over here, the 1-year term insurance rider cost, how it's set up, gradually increases over time. But look at this. We did not drop it after year 10. In this particular example, because we set the MEC limit so low, it's a little bit higher than 100K, but still, I didn't want it to MEC, so we extended it, which is easy to do. Just requires an agent or agency looking at it, monitoring the policy, keeping in touch, which is exactly what we do with everyone we work with. And then when the time comes, make the change. And we can also partially reduce prior to that if we want to. So here, total costs, about $33,000. That was based on the current expenses. So again, this is really a matter of preference. Some people like the level term rider. If your intention is to fund for a shorter period of time, it can make sense, can look at both. If you like the idea of having that added flexibility where we can bounce payments up and down, that's often where a 1-year term insurance rider makes sense. Let's progress on to the current and guaranteed costs. So I want to go through this one thoroughly here. On the left, we see current. Current 1-year term analysis. This is on an age 50 male. So it's a policy with $50,000 per year going into the policy. Where is my money going? Base premium, Total input, $50,000 per year. This is the breakdown of the actual price point for the term insurance rider. But here's really the important piece. Term rider, net cost over time. So of his $50,000, if I'm looking at a life insurance policy and I'm saying, okay, I'm giving you, the insurance company, $50,000 per year, or at least I'm committing to the 5K base premium and the term cost, and then adding up to $50,000 per year if I feel like it. However I decide to pay it. I'm paying that in this example for 10 years. Total of 500 grand. Break even point, year 4. He's paid in 200,000. He has 200,000 at that point in time. Nothing after year 10. Money keeps on growing. Where we mentioned term rider comes down, whole life comes up. So look at this. Net death benefit, 1.45 million. Term rider, 1.13, whole life 315. What happens when we throw money into PUAs? We do it for cash value typically. That's why people are interested in it. But it does buy you added whole life death benefit. What happens with this particular 1-year term rider, and most companies function in this manner, is when I add money into PUAs, my whole life comes up and my term rider decreases proportionately. This is why I see this net cost decreasing over time. Even though the cost per unit goes up because the total face amount of that term comes down as the whole life goes up, keeping me level at the total death benefit. Because it comes down so much, my net cost keeps going down. If that makes sense. I know that can be a bit of a complex situation. Fortunately, this is on a video where we have the rewind button feature, which is really nice. But what I want to compare this to is the guaranteed costs as well. Exact same policy here. We just pulled all the data from the illustrations, guaranteed, non-guaranteed, and added the extra data from their software as well. 5K base premium. Term cost is guaranteed to be the same for the first and second year, but look at year 3. Here's often where we see the, I'm going to call it the FUD tactics, fear, uncertainty, and doubt that you saw at the top of the screen with this video, where people say, don't go that route because you can pay so much in fees and higher costs. I once talked to someone that was being sold on a 100% base premium policy, and he was told, you don't want to put money into PUAs because look at the fees and the charges they have on those things. They're ridiculous. It's like, what? No, the PUA is what drives the cash value. Just, yeah, that's the kind of stuff you hear going on all the time. But anyway, to get back on track, much higher net term cost when I look at the guaranteed compared to the current expenses. However, the net cash value still breaks even just about year 5. I've paid in $350. I've got $349 and change. I'm positive year 8, and it still falls off year 10. We chopped off what was remaining. We did a reduced paid up, which is why you see the greater drop here. But point is, maximum cash value, 1-year term rider provides that flexibility. And if I still see my guaranteed cash value produce a strong value, then that exceeds the cost or the potential drawback from that high cost. No, this is a technical one. I know a lot of you like the technical stuff, some don't. So I hope you enjoyed this one. If you have any questions, reach out anytime. And as always, I do hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.